on that jobs number this morning, break it down for us. What does it mean for the Fed?
So, look, I mean, we heard from Jay Powell 2 days ago, and he said basically the economy growth looks good, inflation pressures look muted, and they're comfortably on hold. I think what we saw this morning was that growth again looks good. You had that 263,000 increase in jobs. Inflation pressures look muted. 0.2 gain in average hourly earnings is kind of so-so. So given that the story on the economy hasn't changed, I don't see why, Powell's view of being comfortably on hold would have changed. So I think this is very much doesn't change the narrative, I think, that we heard from the chairman 2 days ago. So I think the Fed is here pretty comfortably on hold at where they are.
And the market's view hasn't changed, Jill. I mean, who would have thought going into this year, after the end of the year that we saw last year, we'd be up in the beginning of May, 18% on the S&P 500 and just persistently making new record highs. Where does it go?
Right. So, yeah, we continued to hit new closing highs in April, and now that we're where we are, we think there's, limited upside to equities at this point. So we've been of the view that the S&P 500 could go as high as 3,000 this year. We have a year-end target on the S&P 500 of 2,900. So we think that at this point you really want to focus more on picking your spots within equities rather than just buying the market wholesale. We do think cyclicals, higher quality cyclical areas of the market, are a good place to be. Many of them are still undervalued. Positioning has been lower. Areas like industrials, where you've started to see improving signs of momentum in some of the indicators we track, better signs out of China. So definitely an area to pick your spots within the market.
Rick, was the vice president in his interview with Eamon Javers earlier today, was he right to be celebrating the state of the economy and at the same time also saying we should get a rate cut?
Well, I agree with the first half wholeheartedly. The second half makes zippo sense to me. Listen, I understand in the political arena, whether no matter what administration, the people they send out when numbers are good, talk it up. I get it. But it just is completely incongruent. As a matter of fact, I would frame it this way. Many people berated the December rate hike. And they said, Jay Powell, bad thing, we need to take it back. Let's really look at the facts. Last Friday, we get 3.2 for first look at first quarter GDP. Today, we get 263,000 jobs, when most think the number should be closer to 100,000, and 3.6 unemployment, the best since November of 1969. You know what that tells me? That tells me that many were fearful towards September of last year. The Fed would be more aggressive. The December rate hike, in my opinion, especially through the positives of hindsight, doesn't look like it was a mistake. As a matter of fact, the next move for the Fed, whenever it occurs, most likely, if things continue, would be another quarter-point tightening. But the reality is that now the stock market isn't thinking, well, oh, my God, this is only because of the Fed. It's kind of Jim Bullard hinted this morning. No. This is really about the notion that the stock market and the economy could do their own heavy lifting as long as the Fed doesn't screw it up. And I think that's what I walk away with.
So, Michael Feroli, what are we looking at this year? 2% economy, 2.5%, 3%? What's your forecast for the year?
Yeah, so I think for the year probably are between 2 and 2.5. Certainly, Q1, as Rick pointed out, was good. Some of that was inventories, which will probably pay back some in the second quarter. But overall, I think the economy looks okay. It's not going to be as strong as it was last year because we don't have the benefit of those tax cuts to boost consumer spending this year. But at the same time, financial conditions look have eased quite a bit recently. The global backdrop is getting modestly more supportive. Some of the trade headwinds are abating. And so I think overall the picture looks, pretty favorable. Not as strong as last year, but still above trend growth, I believe.
Jill, Sarah and I were talking at the top of the show about which of the indices may hit another record all-time high close. The one that definitely won't today is the Russell. Do you think small caps are due a bit of catch-up?
Right. So even though we've been constructive on equities going into this year, one of our calls is that we've expected large caps to outperform small caps. And, even though you've seen a bit of a risk-on rally today, and small caps and large caps have been sort of neck and neck for the year, small caps have been underperforming since last summer, and we expect that could continue. I think there's a couple reasons that we're a little more cautious on small caps, and overall the earnings trends have still been a lot weaker. So both this earnings season, recent recent earnings seasons, expectations, you're still seeing cuts to estimates across the board. And while analysts are finally slowing their pace of estimate cuts, you're seeing those revision trends improve faster within large caps. And this earnings season, you're just not seeing as many small or mid-cap companies beat as you're seeing in large caps. One of the other reasons that we're a little bit more cautious down the cap spectrum is that small caps have really deteriorated in quality. So one of the attributes that we expect to work well this year is higher quality, more stable earnings stocks. And within the Russell 2000, you're seeing a near record proportion of stocks right now that have no earnings, and you're seeing a record proportion of lower quality companies or companies that just haven't been around enough to have a history of earnings stability. So I think you're seeing a focus on that. You're seeing a focus on leverage, where companies down the cap spectrum have seen record leverage ratios, more floating rate debt, and the market is really starting to focus in on that. So those are a couple of the reasons we're more cautious there.